Hi, this is Shamini from SNS College of Technology, and this is the first topic in the financial derivatives, that is derivative meaning and types. In this video, I am just going to give you the basic definition of derivative and what are the different types of derivatives which is available in this market. So before going into the subject, I am just going to give you an important note of this financial derivative. So financial derivative is an important concept in this challenging world. So we have to know the basics and types of derivatives before we enter into the stock market. And if you once you become familiar with these financial derivative concepts and types, definitely you can win this challenging financial stock market, and even you can get placement opportunities in so many companies like State Street Health Services as a financial analyst, and so many stock markets which is available in this world. So that's why we have chosen this financial derivatives as one of the specialization subject under the finance specialization. Okay, so now let's go into the topic. So derivative meaning and types. So in this lecture, I'm just going to cover the meaning and the basic definition and what are all the different types of derivative products which is available in the market. So derivative, as we all know, derivative is a simple English term which is being used to derive something from one thing or some other things. Okay, so derivative is a product. Now coming into the financial concept, so derivative is a product whose value is derived from the value of one or more basic variables called underlying assets. So here we define the underlying assets as basis, index, or even reference rate in this contractual manner. So according to SCRA, that is Securities Contract Regulation Act 1956, they gave a definition for this derivative. So what is it? So it is a security derived from a debt instrument, share, loan, whether secured or unsecured, risk instrument or contract for differences or any other form of security, and a contract which derives its value for the prices or index of prices of underlying securities. So this is the basic definition which has been given by SCRA for the derivative. And basically the underlying assets are equity, forex, commodity. So commodity means everything which includes grains, oil, silver, gold, or whatever which is available in the market, and even any other types of assets. These are collectively called as the underlying assets, and the value which has been derived from these underlying assets is called as a derivative. And we have so many different types of derivative, namely in finance we have forward derivative, swaps, futures and contracts. And in equity derivative we have forwards and futures, options, warrants and finally swaps. Let's see in detail about these types of derivatives in the forthcoming slides. So forward contract. So forward contract is, it is a customized contract between the two parties to buy or sell an underlying asset on time at a price which has been agreed today. That is when they are signing the contract, they are agreeing a price to buy or sell the particular underlying asset in future. This is the forward contract. And one fine example for this is a farmer who is ready to sell or who agrees to sell 500 kgs of wheat at rupees 40 per kg after 3 months to a bread maker. So after 3 months, the farmer sells 5 kgs of wheat at rupees 40 per kg. So he will get rupees 20,000 from the bread maker. and he sells the 500 kgs of wheat to the bread maker. So this is the pre-agreed price. So whatever the price, or it is called as a spot price, that is the price available in the market at present is called as a spot price. So even if there is any hike or loss in the spot price, they cannot go for it, because they have agreed on earlier while signing a contract. So they have to sell it for the same price. This is about the forward contract. And next comes the futures contract. Here it is also a contract between the two parties to either buy or sell an underlying asset at a certain time in future at a certain price. So the specifications in the futures contract of the product, either grains, oil, gold, silver, or even equities, shares, anything, and the delivery date should be mentioned, and the quantity and the price of the asset, it should be mentioned in the contract itself. So this is about the futures contract. And next comes the options. So options, it may be defined as a contract between the two parties whereby one party obtains the right but not the obligation to buy or sell a particular asset at a specified price on or before a specified date. That is, they can exercise this contract even on the date which has been mentioned in the contract, or even before the date of the contract which has been expired. So here they have only the rights to buy or sell an asset, but there is no obligation to buy or sell it. So here we have two different types of options, namely call option and the put option. So call option, it gives the buyer the right but not the obligation to buy a given quantity of the underlying asset at a given price on or before a given future date. So in this example, here we have the party has been given the right to buy 100 line shares at a price of rupees 300, which is the strike price per share after the 3 months. So here the current price is maybe 250, but the strike price is 300, and the expiry date is after the 3 months. The parties are going to exercise the contract, and the premium is rupees 25 per share, and the amount to buy the call option is 25,000, because per share cost rupees 25 and they have a right to buy 100 shares, so you will get the amount to buy the call option is 25,000 rupees. Suppose after a month market price is 400 and the option is exercised, that is the shares are bought. So the net gain is 40,000 minus 30,000. You will get 40,000 minus 30,000 minus 2,500, you will get 7,500 as a net gain. And suppose after a month a market price, if it becomes 200, then the option is not exercised, so net loss equal to the premium amount which has been the amount which has been used or given to buy that contract, that is the amount is rupees 2,500. And the next type is called as a put option. Here it gives the buyer the right but not the obligation to sell a given quantity of the underlying asset at a given price on or before a given date. So here in the same example, here we have that is the party has been given the right to sell 100 Reliance shares at a price of rupees 300 per share after 3 months. So the only difference between the call and put option is call option, it gives the buyer the right to buy the asset, whereas the put option gives the buyer the right to sell the asset. And next comes the swap. So swap is the private agreement between the two parties to exchange the cash flows in future according to a pre-arranged formula. So it has been often used to exchange one kind of cash flow with another. For example, a trader might use an interest rate swap to switch from variable interest rate loan to a fixed interest rate loan, or even vice versa. So here also we have two different types of swaps, namely interest rate swap, currency swap, and even vanilla swaps. So we'll see these different types of swaps in our third unit. And next comes, and these are the three different other kinds of derivative products which has been available. So LEAP, which is abbreviation for long-term equity anticipated securities, and here it has been exercised even after 1 year. And warrants is or the contract which has to be exercised before the 9 months. Okay. And basket, so basket, as we all know, that it is a collection of these securities is called as a basket. So I hope this lecture is useful to understand the meaning and the definition which has been given by CRA and the different kinds of derivative products which is available on this market. So thank you so much for the patience listening. In my next lecture, I'll just share, I'll explain you the futures contract, forward, swaps, options in detail. So thank you.